Hey everyone, welcome back to Corporate Decoder. Today we're diving into Newton Golf Company's latest annual report. Let's see if their financial game is up to par or if they're stuck in the rough. This report is full of juicy details, so stick around. Scroll Newton comes from Scroll Company, Yannick Scroll to Newton Golf Company. Formerly Sachs Parenti Golf makes golf equipment like putters and shafts. They aim to be a technology leader, manufacturing most of their products in the US. But this report also shows they're facing some challenges. One thing to note right away, the auditors are worried about Newton Golf's ability to stay in business. This is called going concern. They've been losing money and burning through cash. They need to find more funding or turn things around quickly. As of June, the market value of their non-affiliated shares was a little over $3.6 million. And as of the end of March, they had nearly 4.3 million shares outstanding. Scroll reverse call Paul. Before we get too far, they did 2 reverse stock splits, one in July and another in March. A reverse stock split means they reduced the number of available shares. For example, combining every 10 shares into one. This can make a company's stock look more valuable. It might sound good, but it's often a sign of trouble because companies do this when they want to raise the stock price to avoid being kicked off the stock exchange. The company faces environmental regulations because of the paints and solvents they use, and they say that they are trying to be compliant to environmental laws. This is good since failing to do so could result in fines. Newton faces stiff competition from bigger companies like TaylorMade and Callaway. These companies have more money and brand recognition, so Newton needs to be innovative to survive. Let's look at the risk factors. These are things the company acknowledges could hurt their business. Scroll risk reduction in the number of rounds of golf played. Scroll. First, if fewer people play golf or if golfers buy less equipment, Newton's sales could suffer. Golf is a discretionary expense, so economic downturns can hit them hard. Scroll or build a strong reputation, as sales may be adversely affected. Scroll. The company says that if they can't maintain their brand image or get bad publicity, it can significantly hurt their business. Social media can make this worse. Negative comments can spread quickly. Also, they rely on international supply chains. Changes in trade policies, tariffs, or political instability could disrupt their ability to get materials or export products. They also depend on their key executives. Losing those people could significantly harm the business. Their auditor has expressed substantial doubt about their ability to continue as a going concern. This is a big red flag. Scroll failure to adequately enforce our intellectual property rights. Scroll counterfeit products are a risk and defending their patents can be expensive. If they acquire other companies or form partnerships, there could be difficulties integrating those businesses. Scroll that we or our vendors collect through Chola websites or stores on servers may result in significant exposure. Scroll cyber attacks and data breaches are a risk, especially with increasing concerns about consumer privacy. Now let's dive into the numbers. Id. Here is a look at the tail of the tape from the income statement comparing this year versus last year. Sales shot up by 887%, reaching $3.4 million. That's great, but keep that number in mind as we move to the next figure. The cost to produce those sales went up too. Gross profit increased quite a bit as well. So far so good, but what happened to all that extra profit? Their operating expenses, which include all selling, administrative and research costs, jumped by 53%. Ouch. Now, here is the real kicker. Their net loss, the actual money they lost, reached almost $12 million compared to a loss of $4.6 million last year. A lot of the problem has to do with financing costs. The company expects cash on hand to last for only 12 more months, so they're going to need to make serious changes. The company notes that the warrant liability greatly affected the losses this year, with several $1 million in financing and changes in fair value being the drivers. Digging through the cash flow statement, their cash used in operations was nearly $5 million. The company was able to raise money but took on a lot of short-term liabilities to do so, as we can see. The company had most of their cash in reputable bank accounts, which is great. Their inventory sits at $913,000 net of reserves. Property and equipment is about $716,000 net of depreciation. There are multiple grants of common stock options, mostly to executives and board members. And those warrants, they're classified as liabilities, meaning they're treated as debt on the balance sheet. The Scroll, the board of directors,